this video, we'll understand what is marginal costing and its terminologies. Let us just try to understand first what is marginal cost. Marginal cost is a cost of producing one extra unit. So if we look at the example, so for 10,000 unit, your cost of production is $50,000, and for 10,001 unit, your cost of production is $50,005. So that $5 is cost of producing one extra unit, and that is known as a marginal cost. So this definition of marginal cost is technical in nature, plus it doesn't give us more clarity. So in order to understand what really marginal cost and costing is, we need to understand its different terminologies. And once we understand those different terminologies, we'll be able to understand what is marginal cost and what is marginal costing techniques. So the first terminology which we need to understand is variable cost. Variable cost is a cost which increases or decreases with the level of production. So if your level of production is increasing, or if your level of production is decreasing, then your total variable cost will increase or decrease accordingly. The important point to note here is your variable cost per unit will remain constant irrespective of your level of production. So if you're increasing your level of production or you're decreasing your level of production, your variable cost per unit will remain constant. Let us try to understand variable cost with an example. Let's say raw material cost. So raw material cost per unit is going to remain constant irrespective of number of units you're going to manufacture. So let's say if your raw material cost per unit is $5, then this is going to remain same whether you produce 1000 units or whether you produce 5000 units. One more important thing is that if you're not producing any units, then you will not have any variable cost. The reason is that you're not doing any production, then there will be no requirement of raw material. If there is no requirement of raw material, there will be no raw material cost. The next cost is fixed cost. Now the fixed cost is a cost which is going to remain constant irrespective of level of production. So if you are increasing your level of production or you're decreasing your level of production, the total fixed cost is going to remain same. So the important point to note here is your fixed cost per unit is decreasing. The reason is more you produce, more you recover your total fixed cost. But again, the total fixed cost remain constant for a particular period. So let us just try to understand this with an example. Let's say rent of factory. So if you are having a factory which is on a rent, and if you are paying $10,000 per year, then in that case that $10,000 is considered to be fixed cost. So if you are deciding not to produce any units, then also you will be incurring that cost, then also you will be incurring rent of that factory. So that's the reason if you're not producing anything, still you will be having total fixed cost of $10,000. Whereas in variable cost, we saw if I'm not producing, I won't be having any variable cost because I'm not producing any units. So one more important thing to note here is your total fixed cost will remain constant at a particular capacity. And if you are going beyond that capacity, then your total fixed cost will increase. So let's say the rent of the factory which we are talking about has a capacity to produce 5000 units. And let's say if you plan to produce more than 5000 units, then in that case, you need to have another factory. And if you go for renting of another factory, then you will be having another fixed cost of $10,000. So if you look at this example, if you are producing more than 5000 units, let's say you are going for 5500 units, then you need additional capacity. You need additional factory. And that's the reason your fixed cost is increasing to $20,000. It is important to note that your total fixed cost will remain constant for a particular period, that is a year in our case. That's the reason the fixed cost is known as a period cost, whereas variable cost is known as a product cost. Now let us just try to understand the definition. So marginal cost, it is aggregate of all the variable cost element. Let's say direct labor cost, per unit plus direct expenditure per unit plus direct raw material cost per unit. So all the summation of this is known as marginal cost, whereas marginal costing technique is a technique of dividing the total cost into fixed cost and variable cost so that an organization is able to take short-term unstructured decisions. Now let us try to understand what is contribution, break-even point, loss and profit. So what is the general formula for profit? So profit is nothing but total sales minus total cost equals to profit. Now in marginal costing, total cost can be divided into variable cost and fixed cost. So I can easily say total sales minus variable cost minus fixed cost equals to profit. And if I go further, then total sales minus variable cost is equal to contribution. Contribution minus fixed cost is equal to profit. So here the calculation of profit is same. It's not changing. It's just that the total cost has been divided into variable cost and fixed cost. And why we are doing this? So that we can analyze it and we can take proper decision. Now let us just try to understand all this with a proper example. So we are taking two cases first. Case 1, which is regarding profit, and case 2, which is regarding loss. So here in case 1, there is a profit. The reason of profit is the contribution is more than fixed cost. And in case 2, there is a loss. And again, reason is your contribution is less than fixed cost. So in both the cases, sales minus variable cost is giving you contribution. But if you are contributing more towards fixed cost, then you are earning profit. If you are contributing less towards fixed cost, then you are having a loss. So what is the definition of contribution? Contribution is referred to as contribution because it contributes towards fixed cost. And if it contributes more towards fixed cost, you will generate profit. If it contributes less towards fixed cost, then you will be generating loss. So in our given cases, in case 1, your contribution is 8,000 and your fixed cost is 6,000. So your contribution is more than fixed cost. So that's the reason you are having profit of $2,000. Whereas in case 2, your contribution is 6,000, your fixed cost is 7,000. So here you are contributing less towards fixed cost, and that's the reason you are having a loss of $1,000. There is a definition of loss in marginal costing, that is irrecoverable portion of fixed cost is known as loss in marginal costing. There can be third case, which is break-even point. So here your contribution is just sufficient enough to recover your fixed cost. So here your contribution is equal to fixed cost. That is, your contribution is 4,000, your fixed cost is 4,000. That means there will be no profit, there will be no loss. And this kind of situation is known as a break-even point. So under marginal costing, break-even point is a point of sales where contribution is just sufficient enough to recover